Now, have you heard of DoorDash before? DoorDash is actually an American food delivery service. Now, let me read for you some important information that relates to today's video. DoorDash is a company that's launched in 2013, and as of December 2020, they actually did an IPO with a valuation of $38 billion. Now, if you go and look at what Motley Fool has to say about DoorDash's business, on one hand, they have customers, which are the restaurants, which do not really like them. On the other hand, they have people like you and me who order on the app. They have multiple choices. Such a business has no comparative advantage in a lot of ways. But nonetheless, $38 billion valuation. Now, with DoorDash's IPO, American exchanges have raised $160 billion in 2020. That is an all-time high. Now, why am I reading you that important information? There's a few key parts. In 2020, the amount of IPOs was 500, and guess when was the last previous peak? That was close to this number. 2000. That was a dot-com bubble crash. Now, there's a few key parts that I also want to share with you. Softbank actually owns DoorDash, and they actually netted $11.2 billion from this IPO. And you may be thinking, how much did Softbank actually invest with DoorDash at the start? Is it $5 billion 3 years ago? Because there would have been like a 50% growth rate already kind of return. Take a guess on it. It's going to surprise you a lot. 3 years ago, Softbank actually invested only $680 million, and now they've netted $11.2 billion. That's how much they've actually made their monies. This goes to show a lot of hot money is out there paying an inflated price to a private equity firm that has just bought that thing 3 years ago. Of course, the business has revolutionized, but right now you're paying a super inflated price. And if you stay for today's video, I'll cover a few key parts. I'll cover firstly, why a market crash is not as far as you think. I'll give you a few key points. And last but not least, I'll end off by explaining how a market crash actually happens. So with that, let's roll in the intro video. Hi guys, welcome back. Now let me start by showing you a finding by Bank of America. They actually did a research and found out the amount of global equity inflows is never been higher before. Now there's more than 50 billion that inflowed into global equities, and that really shows you a state of greed in the market. Of course, you may be thinking this number is always going to be bigger because there's always more money out there in the world. And of course, if you look at some previous peaks in 2008, we did understand that there was a crash that eventually happened. But I don't need to focus on that. I want you to focus on 2018. Surprising important information from there. Now in 2018, that was the previous highest, correct? And let me show you what the equity markets actually performed in 2018. What do you see? A sharp run up in prices, correct? And then a correction. And then a recovery. And then what looks like a crash. 10 to 20% drop very quickly in market prices. Now, why am I showing you that? A few key parts. As of now, 98% of global equities are above the 50-day moving average and 200-day moving averages, which goes to show you that markets are severely overbought. And if we reference back to 2018, what we realize is when you see a lot of people moving the markets, that is typically a period that follows after that of poor equity performance. Of course, we don't know when the top is, but if you invested anywhere in the 2018 period, you've not likely done very well. So do keep that in mind. When hot money, hot retail money is moving in, it typically shows a lot of greed, and that's a proof of things. And that usually poor performance in equities follows. Now, I also want to ask you a different question because I picked up a survey. How much cash do you have in your portfolio right now? Leave in the comment sections below. If you have followed this channel, you do know what I hold in terms of cash looks to be 20 to 40%. I think it's about 30% as of right now of filming. But I want to show you a survey which is done by 5,500 people. What do you see in this survey over here? An astounding amount of people, 53% correct, have less than 20%. 0 to 20%, that's half of the people. And then we see the second highest, 70% of people are already in margin. Now think about it. So many people are almost all in already. What about you? I hope you're not in that state. Because when you are all in already, if you play poker, you do know, if you go all in too many times, one unlucky incident catches you and you go bankrupt. I hope you are not at this state. If you are, it's seriously time to consider whether the risk-reward ratio makes sense or not. So many retail investors right now are 0 to 20%, if not already in leverage spaces. How much money is there to continuously buy up equity markets? Think very carefully about that. I also want to address this topic on hot money is moving into technology right now. I want to show you some examples, and what we can see right now is that technology is the hot sector, correct? Because a lot of narration about it is revenue growth. Where else can get as high revenue growth as technology shares. So everything's about revenue, nothing's about profit. That's what you would realize if you browse around YouTube or you browse around other forums and stuff. I want to show you 3 examples without showing you the name so that you don't get sold by the brand itself. I'll give you just the chart itself for you to decide whether there's too much hot money or not. The first one, let me pull up for you to see. This is actually a cloud computing company. So hiding the name, it's a cloud computing company. I want you to focus on a few key parts. At the start of 2020, there was of course still cloud computing demand, correct? But now maybe slightly higher. The share price was 4 times lesser. The company was worth 4 times cheaper. But so now, from $20, now it is $80 a share. Without showing you the name, think about it. Give me some justifications as to why it makes sense to pay 4 times more than as of 2020. Has business prospect changed that much? 4 times more? Maybe 40% more. I can agree on that. But 400% more? Think about that. Have you demanded cloud services by 400% more? The second one that I'd like to show you, this company is a smaller company, 1 billion cap only. Loss making also, like the first one over there. I don't even know what is their competitive advantage or what's so sexy about it. But as you can see, there's a lot of volume and a lot of run up in share price, correct? Yet another technology player. Without showing you the name, without showing the story, justify why that makes sense. 4 times in terms of price. Last but not least, I have something, 9 billion cap or so. This one moved up 6 times. 600% in terms of share price gain. Now a lot of retail investors are celebrating. They're thinking, wow, they found a great company. Is it really a case? More often than not, we hear that invest in this internet companies, investing for the future. It's all about revenue growth. They are going to be the next Amazon. If you go to other YouTube channels, they're going to tell you that buy this company before it becomes the next Amazon. They're investing for the future. Really, Amazon was an outlier. It was the only one, in my understanding, so many years investing, that really postponed profits and yet continuously build their market share, and they've shown a different way of doing things. Fantastic Amazon, but there's only one Amazon. This is not everybody's going to be a next Amazon. So if you hold on to that, you're only aiming for that outlier. What are your chances of succeeding? So again, justify if you have in the comment sections below, because if you can justify it well, I'll show you the names as to what these 3 companies actually are. Because more often than not, it really doesn't make sense. 1 year ago, you're paying 4 times cheaper. Right now, you're paying such an inflated price simply because of the technology craze. Now, in this next part, let me explain to you how the market can actually crash. And before I get there, smash your like button so more people can see valuable content like this. And again, if you have a question or comment, leave them below. Now, let me address the most glaring reason, which is, Fed printed money, correct? I do understand that. They printed $4 trillion, and that money has to go somewhere. It's to buy assets. That is why equity prices have gone up. S&P prices have gone up. But let me ask you a question. How much has it already gone up? Have you actually discovered that number? If not, let me share a few things. Let's start with cryptocurrencies, which is one of the hottest ideas right now. They have attracted $1.5 trillion already. What about for equity markets? In particular, S&P 500. Take a guess. How much has it gone up in value already? That number, $5.8 trillion. Fed has printed 4 trillion, cryptocurrencies have gone up 1.5 trillion, and S&P 500 has gone up 5.8 trillion. Let me ask you this question. Is there still so much money out there that needs to be going into equities? Think about it. I've even factored in properties, which have probably appreciated, bonds, which have probably appreciated. Is there really so much extra money that has to definitely go into equity markets? Or sooner or later, that narrative has to change. So I hope that you are ahead of the curve. Now, let me share with you what a market top actually looks like, which typically precedes a crash. I've been in markets for quite long, and typically things happen like that. So I'll try to explain and give you a feel of things. Now, at the top of the market, there is no warning bells. Forget about it. Nobody is pessimistic. Everybody is optimistic. What you see in newspaper isn't going to alert you that there's a market top. So that's the first thing you need to take note. There isn't a warning sign or even bells ringing. At the top, everybody is happy, but what I typically realize is that prices for some major companies start to slide. Those that hold up the index start to slide. And what happens next is most people typically do not feel that small slide, and there's a bit of rotation into other companies, other sectors. That typically is what a market top looks like. The slide nobody can really realizes, and very soon the prices are a little bit cheaper than before. Then what happens next? There's always a lot of enthusiasm. Hey, now is a great opportunity to buy. Prices are cheaper than the peak. A lot of, right now you should expect social media to tell you this is an opportunity, buying opportunity. And I've actually prepared two interesting quotes. I'd like to show you how, this kind of fear of missing out messages actually sound like. Let me quote you the first one without naming names to things. We have never seen this amount of change before at the same time in history. The future is here. And if we don't invest now, we are going to lose out. Very scary, correct? Very fear of missing out driven, correct? This is actually a very reputable fund manager using such a language. A second quote that I'd like to share with you. Sell everything and buy more Tesla. I'm serious. Everything else I'm invested, I'm selling all. I have a high degree of certainty that Tesla stock worth 10 times. Very dramatic, correct? This is actually by a very popular YouTuber. Now, again, this is the kind of positive fear of missing out messages that typically happens that drives investors to take note. Hey, this could be an opportunity. The prices are slightly cheaper already. Let's rush in. And when do investors typically rush in is when there is a small rebound suddenly. This rebound actually attracts in the last weak hands in the market. Everybody that was really on the sidelines, seen this fear of missing out language, seen this recovery close to a peak, is now going in. This is the last participant to the party. That is why a market crash happens like that. They've attracted in the last weak hand, and then what happens next? It reaches the previous peak, and then a very sudden drop. Typically, a sudden drop is explained by some global trade tensions, some war thing, some reason. There's always a reason to a crash, but that reason does not need to make a lot of sense. That is enough to spook the markets, and investors or traders start to rush out for the exits because prices drop very quickly. That is why a crash happens. At the top, nobody really realizes it. It slides down. There's this fear of missing out, of breaking a new peak. People rush in, and then that exit rush happens. Hopefully that explains to you why a market crash can happen, and it's actually not as far as you think. Don't get me wrong, I don't have an idea. Is it going to happen next week or next month? Don't ever sell everything because that is foolish. I'm not advocating that. What I'm advocating is if you believe markets are expensive, stay slow, stay invested, because you never know when crashes happen. But also think very carefully on your purchases, because if you're going in all in right now, like what I've been suggesting in the previous survey, you're going to get into trouble. So if you still have a lot of cash, yes, you should invest and be very selective. But if you're over invested, now is the time to be cautious. Something I've been preaching on this channel. I hope I'm wrong. I hope markets stay higher because I benefit also. Who doesn't want a high market? But I've always wanted to share with you my honest feelings on things, and that's why I produced this video for you. With that, press on subscribe, because subsequent weeks and months I'll be sharing with you breakdowns as to where you can still invest with good valuations. And if that interests you, continue watching on. So with that, I'll see you there. Take care and goodbye.